Hi doctor, my name is Li Qianrou and my metric number is 303073. I'm the person to do the introduction part about our group's assignment. And our group's assignment topic is rate fluctuation. Let's start with a simple fact. Exchange rates change all the time, and those changes, up or down, affect more than just people trading currencies. They affect the price of your imported phone, the profits of a local exporter, and even how stable a country's economy is. But here is the puzzle. For decades, economists have tried to predict exchange rate movements, and they have often failed. As Fang, Wei, and Wang explain in their 2024 review, the well-known Massey-Rogov puzzle is still with us. Simple economic models cannot consistently beat a random guess. That is why researchers have now turned to things like market psychology and trading behavior to understand what drives rates. Now, why does this matter for ordinary people? Because exchange rate changes do not pass through to prices in a simple way. McKinsey and Tuzon studied 5 emerging economies, often called the Fragile Five. They found that when a currency drops in value, the rise in inflation can be much larger during uncertain times. In other words, rate fluctuation can hit household budgets harder than many expect. And here is something you might not expect. Leaky Tapiwat, Girapal, and Tripang Karuna found that companies more exposed to climate exchange are actually less likely to hedge against exchange rate risk. That means they become more vulnerable to currency shocks. So rate fluctuation is not just an economic issue, it is connected to environmental risks too.
So I'll be talking about the main causes of exchange rate. So the first of all is the changes in oil prices. So as we know, Malaysia is an oil exporting country. So as an oil exporting country, we heavily depend on the world's oil prices. So for instance, if Malaysia's so when the oil prices fall, so obviously Malaysians will earn less in revenue from exports, causing the ringgit to weaken. On the other hand, when the oil prices rise, the ringgit usually becomes stronger because foreign country will have more confidence to invest in Malaysian's economy. Second, we have the strength of the US dollar. So the ringgit is heavily influenced by the US dollar. When the United States increase the interest rate, many investors move their money into US assets because the returns would be higher than normal. So the increased demand of US dollar, and it causes the ringgit to depreciate or fluctuate. Third, is the political and economic uncertainty. So political instability, inflation, or weak economic growth can reduce the investors' confidence in Malaysia. This is because when foreign investors feel uncertain, they may withdraw investments from the country. So this will indirectly cause the country's revenue to weaken, and the demand of ringgit also decreases. So it causes the exchange rate to fluctuate.
In 2025, Malaysia total trade achieved a historic milestone, surpassing 3 trillion ringgit for the first time. This momentum continues strongly into 2026, with our cumulative trade surpassed doubling year to year to 91.9 ringgit billion by April. To analyze how export and import respond to ringgit exchange rate volatility, we must evaluate both trade elasticities and global value chain integration. Standard economic theory uses Marshall-Lerner condition. It detects that a currency appreciation worsens a country trade balance only if the sum of export and import demand elasticities exceed unity. Although the ringgit Malaysia appreciation by over 10% in late 2025, Malaysia trade surplus remain highly resilient rather than deteriorating as simple model predicted. This resilience is due to two key structural factors. First, our E&E export face highly inelastic global demand due to the massive global artificial intelligence boom. Second, a stronger ringgit reduced the import cost of intermediate input, protecting profit margin. Ultimately, Malaysia did global value chain integration successfully inside our integration trade sector from volatility.
My name is Hu Qifei, my match number is 309173, and my part is effect on investment, inflation, and national economic. The exchange rate fluctuation refers to the continuous rise and fall in the value of the country's currency against other currencies. In Malaysia, the fluctuation of the ringgit has significant effects on investment, inflation, and the overall national economic. The first part of the exchange rate fluctuations can affect foreign investment. When the ringgit weakens, foreign investors may become less confident because the value of their returns decreases when they convert back into their own currency. This uncertainty can reduce foreign direct investment and slow economic growth. However, weaker ringgit may also affect some investors become Malaysians assessed and the business become cheaper for foreigners. The second part of this is exchange rate fluctuation contributes to inflation. Malaysia's imports many goods such as food, fuel, machinery, and electronic products. When the ringgit depreciates, imported goods become more expensive. As a result, business increase prices and consumers experiences a higher cost of living. This situation is known as import inflation. And the finally part about this is exchange rate fluctuations impact the national economy as a whole. A weaker ringgit can increase export competitiveness because Malaysian products became cheaper in the global market. However, excessive fluctuations create some economic uncertainty, affect business planning, and may slow down economic stability and growth. Therefore, maintaining a stable exchange rate is important for controlling inflation, affecting investment, and ensure sustainable economic development.
So to wrap up everything, exchange rate fluctuation is really an unavoidable economic reality for Malaysia. As we've talked through, the ups and downs of the ringgit don't just happen by accident. They're driven by global market changes and our own domestic economic situation, touching almost every part of our country. For Malaysians, this means both advantages and worries. A weaker ringgit can help our local exporters, from manufacturing to agriculture, sell more products abroad. But at the same time, sudden currency swings makes imported goods and daily necessities more expensive, pushing up inflation and lower our everyday purchasing power. It also makes foreign investors more hesitate, slowing down foreign investment and creating challenges for our national economic stability. Overall, exchange rate changes bring both opportunities and risks to our trade, investment, and people's daily lives. Moving forward, Malaysia needs steady monetary policies, more diversified trade, and stronger economic foundations to reduce these negative impacts. Keeping our exchange rate stable will always be essential for sustainable economic growth and a better life standard for all Malaysians.